Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTC QB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back to the show, Jim.
Ross, Scotia Economics released a report claiming immigration into Toronto and Vancouver would save or reverse the housing correction and move prices higher again. Will that actually happen?
Will that actually happen? These sort of comments coming out of bank economists and housing analysts are just hilarious. You know, they've used this immigration issue with Toronto or Vancouver for, you know, since I started selling homes. It was the same story. Oh, housing prices are always going to quickly go back, or the housing market it can't withstand this slowdown because of pressure from population growth. And I'll tell you, Jim, you know, I probably believed that for about 15 to 20 years. I probably believed it. I believed it because I didn't step back and do some hardcore analytics on that fact to see if that was myth or truth. And as it turns out, in typical real estate fashion, it was nothing more than a myth. And what I would have responded to this economist would be this. The Great Housing Correction in Ontario lasted from January of 1990 right on through till the middle of 2003. 13 years. During that period of time, and actually the correction began earlier than that, back in 88, but the rest of the world came to that realization in 1990. That said, during that 14-year period, so I'm going to use the 89 till 2003 window, there was a 20% gain in the population in the province of Ontario. So the province of Ontario had a 20% increase in the population over those 14-year window. At the same time, mortgage rates went from 14% in early 1990 all the way down to 6% in 2003, effectively cutting the cost per 100,000 of mortgage in half. So it used to cost you $1,200 a month for a $100,000 mortgage in 1990. It was only costing you $600 a month at the lowest point of 2003. Your cost for your mortgage dropped in half. Your number of population, the population increased by 20%. The other fact is, over those 14 years, house prices in 2003 were exactly the same as they were in 1990. The Great House Price Correction ended 2003 with house prices returning to what they were at their peak in 1989. So you had a 20% increase in population, tons and tons of immigration. You had interest rates effectively dropping the cost to carry $100,000 of mortgage in half. Yet housing prices didn't change for 13 years. And here we are, a mere 2.5 years into the Vancouver correction, a year and a half into the Toronto correction, 2.5 years into the Toronto correction, 3.5 years into the Vancouver correction. in terms of house prices alone. Of course, as I've said on the show, these markets turn a year and a half, 2 years in advance before anyone knows about it. And we already have bank economists going in the news headlines claiming that the housing markets are going to turn around because of immigration. Demand for our housing is so strong that this demand is going to drive house prices back up. Yet, the last correction, 1989 to 2003, 14 years, 20% increase in the population, and your mortgage carrying costs dropping in half. And there was no increase in house prices. Your listeners have got to question these people who are giving advice to the public at free, just without being questioned by the people that are interviewing them. We are looking at part of the interest rate cycle where interest rates are at best going to remain flat. I mean, even if the Bank of Canada had to jump into QE3 and drop interest rates, there's very little room for them to drop them. So we are now in a cycle where interest rates are going to be rising. The population will not be able to grow as strongly as it did through that 14-year period I was referencing before, because we are already at 37 million people. We are not going to have the same percentage change in immigration rates. Immigration rates are falling because you can only let so many people into your country. And as a percentage of your overall population, that rate is going to decrease. I mean, one of the funniest things, Jim, that we always laugh at is how come nobody talks about the immigration rate? What percentage of the population each year are we allowing new immigrants to make up? That is never something that's really ever discussed. And I mean, even do a Google search and try to find a StatsCan chart that shows the immigration rate from, 1990 till 2019, and I don't believe you can find one. So maybe that's why these economists believe all these myths, how the new immigrant households are going to hold housing prices higher in Vancouver and Toronto, when in all other housing corrections, the immigration rate was higher, but that never happened. Not only that, they're also saying in a rising interest rate climate environment, even if we're holding rates steady, that still means effectively rates are rising, the way that we calculate housing markets anyways. This is going to cause a resurge of prices. It is ludicrous. A historical perspective shows that it has never happened before. The immigration myth, the population growth myth, has been debunked with 50 years of real estate data. It is a cyclical function. A housing market works on cycles. These cycles in aggregate create problems in the housing market, and then you have solutions. I'm watching right now, Jim, where I'm hearing in Toronto, in Vancouver, that rents are falling. We're starting to see those little news headlines that say so-and-so is reporting that rents are dropping. Yet it was only a few months ago when everybody was complaining, rightly so, about higher rates. Well, what people don't understand is all of these so-called experts talking about rates, they're never talking about the existing rental stock. They are always, or the existing tenant base. They are talking about new tenants. When a tenant from one condominium, an old 30-year-old building, moves into a brand new building that an investor purchased a speculative condo on, of course those rents are going to jump hugely, because the quality of the unit that you're renting is jumping equally as high. Only the people who are the wealthiest enough as tenants, who can afford to rent one of those new higher quality units, are the ones who leave their existing tenancy for the new one. Now, I understand tenancy rules are different across the country, like Ontario has rent control. So what that means is in Ontario, an existing tenant of an existing building or house will not experience a new rental increase of more than inflation, barring some major some work being done in the property. The vast majority of rents in Ontario have been adjusted with inflation from 1990 forward. They haven't changed. The only thing that changes is the new rental stock, the new tenancy agreements. Those, of course, are going to be disproportionately higher because they're disproportionately in a higher quality of rental. So, all of these myths that are out there, all of these myths that innocent young families are listening to and making the largest financial investment of their life, they're committing to 25 years of mortgage payments, are rooted almost entirely in myths. And this Scotia Economics report that you cited is a prime example. A housing market at the end of a cycle has no bearing on new immigrants coming into your marketplace or population growth. Forget immigrants. Let's just talk population. It doesn't make a difference. And your proof is the great correction of the province of Ontario for the 14 years from 1989 to 2003. 20% increase in population, mortgage carrying costs drop in half, yet house prices do not change a penny from the start to the end. That's why it's called a cycle, folks. And that's why these economists we call economists, because they do not, when they're talking about the housing market, they have no idea what they're saying. They're simply regurgitating real estate, organized real estate sales talking points, which have infiltrated the psyche of our nation. The only thing that cures this is a house price correction. Sadly, the damage that is done in a correction is immeasurable. Anyone who is out there looking at the market, you need to be getting honest advice over where you are in your home ownership situation, your buying situation, your selling situation. You need to get rid of these myths. You need to learn that what you have been told for the last, I guess maybe since the day you were born, is rooted in myth. Yet, in the end, even though I will tell you not to buy a home today, I still believe 100% that the only way to accumulate wealth in your lifetime will be through home ownership. So I am still going to recommend that you become a homeowner, or that you work your way up the property ladder, that you get that dream home that you've often wanted. What I'm just saying is you need to enter the market at the right time. Listening to a Scotiabank economist, you are guaranteed to enter the market at the wrong time.
We'll have more with Ross Kay right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome back. We're speaking with Ross Kay. Ross, do you have a new way that people can measure their credit score?
Yeah, Jim. So later this week, and I don't want to pretend to our listeners that we did not have some advanced knowledge that this is coming out. We have created the first financial tool in Canada specifically designed to reverse who controls the conversation in credit lending in this country. All of your listeners, I'm sure you know, Jim, that everyone uses a FICO score. So you have a credit score. Every day on television, the radio, news, we hear these comments about get a free credit report, get your credit score. If you're going to go to get a mortgage today or get a loan of any kind with the bank, they're going to look at your credit score. They are going to use that credit score to leverage the highest interest rate possible they can out of you. With B20 in particular, they are using credit scores to leverage higher earnings for their banks as mortgage originations are falling. You are now hearing that start to be reported out in the news, which we warned about here on the show over 2 years ago. The banks have always used credit scores against the consumer. Oh, well, your credit score isn't high enough, so we can't lend you this amount of money. We can only lend you this. Your credit score is not high enough, so we have to charge you a higher interest rate. You walk into a bank to get pre-qualified for a mortgage for a house. The bank looks at your credit score, they look at your financial situation, and they tell you how much they're going to lend you. For our members, so the wealthy homeowner, and for anyone who has access to our new score, we have turned the tables on the bank. Because what we have created is a new score. I'm not going to announce the name here on the radio today. And it has taken us 5 years to be able to create a methodology where an average consumer can walk into a lender, sit down, and ask the lender how the lender is going to improve the consumer's mortgage score. Obviously, we're not going to call it a mortgage score. This is what it means for your listeners. If you walk into a bank in Vancouver, the Bank of Montreal, and you ask them to qualify you for a mortgage, and the bank will effectively tell you how much money per $1,000 of earnings that you make, they will lend you. They will tell you how much of what percentage of your income the bank, will allow you to spend. They are going to constrict your credit based on that discussion. Right now across Canada, that credit constriction is hurting Canadians from coast to coast. It is the reason why, effectively, credit has been shrunk 40%. Your listeners are not going to see this in print anywhere. The people listening here are not going to see that in print anywhere. All of our dashboards have already got that built in. We're not even in a discussion with these sort of things. The amount of credit you can borrow per $1,000 of earnings has been decreased by 40% since peak credit was available. It has dropped by 40%. The banks are now using that against the public's best interest. They are using that to squeeze consumers for more interest payments, higher interest rates. They are telling young home buyers that they can only buy a substantially less pricey house than what those first-time buyers may choose to have wanted to buy. They are telling all buyers, all home buyers, that you have to buy less house today. You have to buy less house not only today, but you have to buy less house than what the last 40 years of home buyers have been able to access because of what the bank is telling you they will lend you. That is all changed with our new score. This score allows you to walk into a lender and walk into another lender and ask that lender to increase the amount of your income you are allowed to pay towards a mortgage. It has never happened before, Jim. B20, when B20 was first discussed in the fall of 2016, it was a critical time for us. We were looking at all types of different ways that we could capitalize for our members. B20 was that capitalization. Because what I'll tell you, Jim, is universally, from coast to coast, B20 is misunderstood. It is misunderstood because it has never been looked at from the perspective of the mortgage lending infrastructure. The mortgage lending infrastructure, up until 2016, remained unchanged. It was exactly the same back in 1987 when I first got my real estate license, right on through till 2016, 5 years after I had given my license up. It had never changed. The home lending infrastructure was identical. There were some minor changes to it, but the levers were all the same. Then, in 2016, the OSFI stepped in and changed the mortgage lending infrastructure for the first time in 30 years. That change created an opportunity. That change required looking at the home lending infrastructure and changing your viewpoint on it. That change has allowed us to reverse 30 years of banks squeezing the consumer into the consumer squeezing the bank. We now have the ability for anyone in any municipality in this country to walk into 3 or 4 lenders, sit down, and ask the lender, what are you going to do to improve my situation? This is my credit score. This is my income. This is the town that I want to buy a house in. What are you going to do to improve my ability to buy the most expensive home that I see fit? Most of you listeners don't understand, Jim, that for the last 30 years, the vast majority of home buyers spend between 30 and 32% of their income on their home in the first month that they move in. So what I'm saying is your monthly income, 30 to 32% of that is going to go towards your mortgage payment, plus your property taxes, plus a little bit of heat and hydro. If it's a condominium, there's a condominium calculation. On November of 2016, that changed. The government effectively changed the amount that they would allow you to spend from your income each month on a house. They changed it. First time in 30 years, it changed. We went back in over the last 2 years, looking at all the rules and regulations, reviewing the banks, reviewing the credit unions, reviewing the private mortgage corporation, looking for the best way to approach this new mortgage lending infrastructure. And what came about, Jim, is that now a home buyer, a home owner can walk into the bank and demand that the bank improves that buyer or owner's situation, or they will go get their mortgage somewhere else. And it is a huge swing, Jim. Let me explain this to your listeners. If you buy a home in Vancouver, you can spend more of your income on your mortgage than you can if you move to Langley. The government will allow you to spend more money. You can take out a bigger mortgage in Vancouver with the same credit score, the same income, than you can in Langley. Yet you have not heard that anywhere. What we have done is reverse engineered B20. That's all we've done, folks. We have reverse engineered B20. We have taken the legal parameters that the OSFI has outlined, and we have capitalized on. We have capitalized them in the same way that we've capitalized on everything at the wealthy homeowner. What you have now, you now have access to a tool exactly the same as a credit score, except it's reversed. Where a bank uses a credit score to squeeze you, you use this new score to squeeze the bank. Not only are you going to use this score to squeeze the bank, you are going to actually use this score, Jim, to decide where you're going to buy a house. This score shows home buyers and homeowners where they should be buying their house. It shows them the impacts of the choices that they're going to make. It shows them why a condominium versus a detached house has a huge difference. We are going in now, and we are maximizing. We have been able to maximize for those using our score. They can now walk into a bank and borrow the exact same amount of money as they did in November of 2016. So where everybody else in Canada is constrained by 40%, those using this new tool are no longer constrained. So as housing prices fall and the opportunity to build wealth increases on falling prices, in other words, you can buy a higher and higher quality of house as housing prices fall by simply spending the same amount of money because you're getting more and more quality. You are going to be able to capitalize on the market like your parents did and everyone before you up until 2016, because no one else in Canada is going to have access to this same tool. You are going to be able to go into the bank with a printout that says, these are the terms that you can change that are going to allow me to use your bank. If you're not going to change these terms, I'm simply going to go across the street. And some of the terms, it takes a little bit. It's a little bit of a complicated work because the terms for each bank are different. The discussion that you're going to have with your banker is different. Whether you choose Bank of Montreal, CIBC, or a credit union, or a mortgage investment corporation, it's all different. This tool is built to allow all of those different competing businesses to compete for your business. This is not simply someone going out there and saying, hey, what's the best interest rate you can give me? While interest rates are important, they are no longer, with B20, the most important function. B20 changed those rules. The entire mortgage lending infrastructure changed on November of 2016, and it will never be the same again. This is the only tool built to allow the consumer to capitalize on B20. It's the only tool built since B20 came into existence to assist you in mortgage borrowing. It doesn't mean that you're going to be irresponsible. What it means is, while everybody else has constricted credit, which will naturally cause house prices to decrease, you are going to be able to go into the market similar to what everybody did prior to 2016. You can still build wealth the exact same way as your parents did. Without this tool, that is not possible.
So Ross, you'll have more details about this when we chat next week?
This tool will probably not be released to the public, Jim, in the foreseeable future. It's too valuable. It is something now that makes our zero risk, no cost format work.
So it's for members of the wealthyhomeowner.ca.
Until further notice.
Yeah, well, of course. It's your invention.
Yeah.
We'll have more with Ross Kay right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, HELOCs, or home equity lines of credit, appear to be rising in Canada. Is this a problem?
It's not a problem. I'm so sad to hear, this making news headline, talking points for people who are guessing about the housing market and false risk being assigned to the Canadian housing market and the Canadian consumer, the Canadian homeowner. When B20 came into effect, you would be incompetent in terms of your understanding of the home ownership market, not to understand home equity lines of credits were naturally going to increase when B20 came in. B20, by its design, meant home equity lines of credits were going to go up, which is exactly what has happened. At the same time, mortgage lending debt, that recorded through traditional measures with the Bank of Canada, that is reported to be falling, has been falling. I mean, we can't make this stuff up, Jim. You have mortgage debt falling and home equity lines of credit increasing. Of course that's what's going to happen. And it's going to happen at the end of every trading cycle. That is naturally what's going to happen. There is no more risk being assigned to those taking out the home equity lines of credit. That is not a risk measure of the Canadian housing market. The only risk measure in the Canadian housing market, Jim, is falling prices. And is the velocity of the market able to sustain house price growth? Canada's housing market lost enough velocity 2 years ago that there was no longer any way housing prices were going to increase. We know where a housing market is going to be, Jim, about 2 years in advance. Now, it will, in terms of pricing, it ranges between 2 years and a year. And that is because we measure house price velocity. Now, velocity consumes a lot of things. It consumes the resale market. It consumes the new sale market. Is made up with. It's made up with interest rates. It's made up with the rules and regulations. It's made up of demographics. It's made up with how the housing stock is structured and what new housing stock is being added. All of those things, in aggregate, can be calculated to come up with what your house price velocity is. What I can tell your members, or tell our listeners, is this: from 1980 till 2019, house price velocity has measured the housing market a year to 2 years in advance, consistently, nonstop. The housing correction that caught everyone off guard in 2008 was measured in house price velocity. The house price velocity turned negative way before the Canadian housing market turns negative. Velocity dictates. It's no different than a car, Jim. It's no different than your car. You're driving your car down the road and you take your foot off the gas. Okay? You still keep moving forward, but your car slows down over time. To speed up, you have to keep putting your foot down in the gas more and more and more. There is more velocity going into your car. You're burning more gas at an increasing amount. These numbers are black and white numbers. Again, why no one else knows this, I don't know. But we are measuring housing market velocity every single month. And it will tell us where the Canadian housing market is going to be a year from now. There is no change in this. If the velocity changes, so in other words, if the velocity picks up again, then we know that the housing prices are going to, at some time, if there's enough velocity, flatline and start to go back up again. If the velocity doesn't pick up, then we know that the house prices are going to continue to decline. Now, I want your listeners to understand, even if the housing market seems to be picking up steam, you need a certain amount of housing market velocity to create house price pressure, upward house price pressure. House prices do not go up unless there is an aggregate of activity that justifies those prices increasing. In other words, you've got to push your foot down enough on the gas so that you start to speed up again. You can hold your foot in the gas, and your car will keep going at the same speed. House prices would stay the same. But of course, for the housing market, they never stay the same. You put your foot in the gas, you take it off. You put your foot in the gas, you take it off. You put your foot in the gas, you take it off. Each time, house price velocity changes. And a year later to 2 years later, that velocity is recorded in the average selling price of a Canadian home. This has happened consistently, nonstop, since 1980. This is not a fabricated metric. This is simply a metric that measures house price velocity. So, home equity lines of credit are not rising disproportionately to what the housing market is saying they should be rising. What's happening is your mortgage lending credit is declining at the same time HELOCs are increasing. This has happened time and time again since 1980. The same pattern has been followed. As home equity lines became more common, the practice itself also became more common. We are now at a point today where home equity lines of credits are no different than a car loan. People treat them exactly the same. So what you're seeing is a natural end post-peak of a housing market where the home equity lines of credit increase at the same time overall mortgage lending is being reported as having smaller year-over-year change.
Ross, thank you so much for chatting with us.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.